Bombay, and formerly associated with Prime Minister's Economic Advisory Council as the member. And her core areas of research are institutional and open economy, macroeconomics, international finance, and governance. Ma'am has a lot of achievements in terms of publications and awards at national and international level, like the Fulbright Research, Senior Research Fellowship, and others. We welcome you, ma'am, for gracing the occasion and for delivering the keynote address. I'll hand over the session to sir to take over. Sir.
All right. I won't take much time. We are here to listen to Ashima talk about macroeconomic policy lessons from the pandemic. I think all of us recognize that the pandemic has forced us to do a fair lot of thinking about what sort of macroeconomic solution should we adopt. We've been hearing a lot both from the Chief Economic Advisor and other representatives of the government, how the government has managed it. There is a lot of discussion today in the international community across economists, macro policy experts about how pandemic has forced governments to make some very hard choices. So without much ado, I don't think we can get anybody better than Ashima to talk to us about these developments. I think we would be best served if I stop talking myself and let you all listen to Ashima. So the floor is yours. I'm going to sit down so that way I can see me better.
Thank you for the introduction. Thank Mahendra Dev for the invitation, Tripura University for its hospitality. It's very nice to visit the Northeast and to see the development that's taking place in different remote corners of India and how in some ways we are becoming very uniform but while retaining our uniqueness. So this has been a very fascinating time to be involved in policy and to come from an academic background with certain sort of structures in which I used to sort of think about the economy. And I find that some of those structures have held up very well in understanding what has been happening. And I'll start with certain controversial, people used to tell me when I used to do my academic papers that this is not macroeconomics, this is development. In India we had to, so I like to think of it as a transition economy, as an economy that has to move to much higher per capita income. And therefore steady state macroeconomics, which is taught in textbooks, doesn't really apply. Macroeconomic policy is not limited only to stabilization. The effect of money and is not only limited to prices and inflation. And I've been arguing and I've found, sort of looking closely at practice, that if you use structure, context and flexibility, it's possible to establish inflation targeting without a large growth sacrifice. When India started on this path, we were told, IMF told us, a lot of experts who take a very conservative or extreme view, this idea that money only affects prices and so on, that initially you need to have a large growth sacrifice in order for people to internalize the inflation target. But I think our experience suggests this is not true. We have seen that the Indian economy has outperformed after the pandemic. Inflation has been within the tolerance band largely and is approaching the target. In fact, it's been approaching the target a number of times, and then we've been jolted by some supply shock or the other. Overall growth recovery has been good with financial stability and movement towards fiscal consolidation after the large rise in deficits and debt during the pandemic. But what made this feasible? I argue that policy was adapted to structure, was balanced between demand and supply, and was tried to implement an equilibrium real rate and an equilibrium exchange rate. And in order to do this, it was very important to establish independence from the US Fed. And since markets and analysts play a large role in the economy now, there's a lot of pressure from whenever the spreads decreased or reserves started falling, that given the large inflows and the integration, we have to, if the Fed is raising, we have to raise. But we raised about half as much as the Fed raised. So again, we'll look at this in more detail, but other things that make this possible, this independence from the Fed allowed policy to be counter-cyclical and to smooth shocks. Now emerging markets face a lot of shocks from outside. In fact, it's reversed the causality, the origin of shocks compared to what they used to be earlier. What was also very important was monetary and fiscal coordination, especially because there are so many supply-side actions that are more effective in reducing the kind of inflationary shocks we are subject to. And if inflation is coming down with these actions, as well as anchoring inflation expectations, then real rates can be kept below growth rates. The advantage in a transition economy is growth rates can be high. But earlier this used to be very volatile. So, but if R is less than G, then automatically debt and deficit ratios come down. Finally, if there's time, I'll compare briefly with textbook advice and with advanced economy actions during the pandemics. So was it reforms that was responsible for India's outperformance? That's the government view. Or did policy also play a role? What is this outperformance? The perception was that India was doing very badly. 1920 growth had fallen to below 4%. And there were NPAs, the financial sector was in distress. So a lot of the commentary that time said that structural changes were needed for growth to recover. And the global shock, starting with the pandemic, the era of poly shocks, is supposed to make matters much worse. But recovery surprised on the upside. We all know how over the last 3 years, initially people said that this is just a dead cat bounce, a recovery from the fall during the pandemic, but it's lasted 3 years now. And the interesting thing is that the revisions are always upwards. Another thing we heard was that MSMEs, small firms, had suffered. That doesn't show up in the data, so revised data revision will be downwards. But it has always been upwards as better data came in. And as I said, headline inflation, despite major supply shocks, over the term of this MPC, the average till November, and now it's coming down more, is 5.8, which is below the upper band of 6%. Now, if there were fundamental constraints on growth, then this outperformance is a puzzle, since major new reforms take time. And if, as the government argues, only reforms are responsible for better performance, then why didn't they deliver in the 2010s? And Rajan has recently said, because he made this statement that we'll be lucky if we grow at 5% over the past year. And to explain the outperformance, he said it is because global growth is higher than expected. The rest of the world was doing better, therefore we did better. But then the rest of the world was doing pretty well pre-pandemic and we were not. So what has changed now? What is the contribution of macroeconomic policy? I have a number of papers on this. One paper shows, they're looking at high-frequency data. There was a turnaround in end 2019 as monetary policy, liquidity provision improved, etc. And this was before COVID-19 hit in March. So because 1920 and 2021 COVID impact, the pandemic impact, this was not recognized that there was a severe tightening of monetary financial conditions since through the 2010s. And in the 2010s and 20s, we had major external shocks. The global financial crisis led to over-stimulus. And because we had double deficits after that, there was over-tightening. So I say that macroeconomic policy was pro-cyclical in the 2010s. There was overreaction. But now in the 2020s, we were counter-cyclical and it really helped. Over the 2010s, the focus was on structural reform, even for macroeconomics, establishing inflation targeting, imposing a growth sacrifice, So this led to underperformance. In 2020s, we smoothed shocks. It led to outperformance. So there was and it's not just monetary, fiscal, even regulatory tightening because of the state of banks. Now, in the literature, there is a lot of endogenous growth literature where it is said that countries that are catching up can double per capita income in 10 years. And this doubling is policy dependent. And what is really important among policies that help is openness and use of technology. So I would suggest that the Indian experience suggests that smoothing external shocks and avoiding domestic shocks is also necessary. Reforms are very important, but not the traditional land labor which leads to political resistance. What really seems to have worked is a focus on complementary reforms that lowered costs in the economy and were in line with comparative advantage and technology trends. So to briefly, I've been the number of papers that talk of this in the past, I've often so I'll just go over this quickly. The structure of aggregate demand and supply in India, because we have large unemployment, so the aggregate supply curve is somewhat flat. The aggregate demand is a normal shape, but we are subject to a large amount of supply side bottlenecks and shocks, which are not like a VKRB, rather it's vertical and it shifts leftwards, but it's flat, but it shifts upwards. So therefore it has a large impact on inflation. Now if inflation is high because of these kind of shocks and you tighten demand, then you do reduce inflation, but by a very small amount, while you have a very large negative impact on output. So, but what are the implications of such a structure for macroeconomic policy? People have told me, I remember Ramachandran was telling me this once, that with this kind of framework there's no role for monetary policy. But I'm going to argue that there is. First, fiscal, obviously the fisc can act more on the supply side. And we've seen counter-cyclical use of excise in oil and active intervention in the food economy, of which India has a large experience, and how this has helped bring inflation down over the past few years after shocks. But also, since the AS is volatile, the target for inflation is the headline, which includes these food energy shocks. And I've argued that in India, factors such as poor governance, cross-subsidization have led to chronic cost push. Not only is the AS volatile because of food and energy shocks, but there are also pressures that tend to push it upwards. And here, continuing improvements in supply as well as longer-term reforms can reverse this kind of. So there's no time, but the fiscal actions can be divided into those that have short and long-term effects and can improve. This as an excise cut can affect oil price shock, but GST and no longer having those octroi posts has a long-term impact in reducing costs for industry. And then the composition of government expenditure more on infrastructure. I'm really happy to see the connectivity improvements, the modern airport we are seeing in Agartala. So all this really, I again have a paper which shows that expenditure, and Bhanu also has some work on this, that expenditure multiplier is much higher under infrastructure spending because monetary accommodation becomes more feasible. And we've been seeing that happening over the past few years. And then moreover, a counter-cyclical conservative fisc reduces risk premiums. But what is the role of monetary policy and flexible inflation targeting? It really fits this ADAS structure. There are people who argue that inflation targeting can't work in India. There are people who argue that it has to be strictly implemented. I think that the flexible inflation targeting is exactly right, and that's what's been implemented the past few years. Because with that structure, there's a very high cost of traditional stabilization. It is better if policies work together to shift down that AS curve. So we've seen how the government can do it, how fiscal policy can do it, but monetary policy also communicates on the inflation target And that inflation target, as it becomes internalized, it enters wage price setting, rental contracts and so on, and then it brings down, it shifts down that aggregate supply curve. So it is forward-looking, and not only does monetary policy have, so it affects future price setting. It's not just the repo set today, but its impact on price setting in the future. And we have a number of analysts, and there is discipline from competitive inflation forecasts. Sometimes for the policymaker, it can be, in the early years, inflation forecasts were really high because they justified a high repo rate. So it's important that there is discipline from external forecasts also. And inflation targeting does not mean that you're neglecting the many other issues that are relevant in a developing economy, because it is for better communication that the many objectives and multiple determinants are condensed into two variables, which is inflation and growth. And the communication is largely on inflation, helping factor in that, push in that 4% target. Policymakers, price setters, households, firms should internalize that inflation targeting. And for credible anchoring of inflation expectations, all that is required is that the repo should exceed expected inflation by whatever the natural real rate is at that time. And this real rate changes with the cycle, falls in a slowdown and rises in a boom. So this is what I think we have sort of succeeded in keeping the real rate near the equilibrium rate during these past few years. And in this structure, monetary fiscal coordination is very, very important. I think in the early years of inflation targeting, the idea was that independence of central bank means there should be absolute, very touchy about any kind of coordination with the government. That is a dilution of independence, but that is not true, because the repo rate is set conditionally. That is, if inflation is high, there's not adequate supply side. There's not adequate supply side action, then the repo rate will rise. So that credibility is there, and it is consistent with central bank independence. But again, research shows that the interest elasticity of demand is very high in an economy like India. That Krugman was saying recently in the talk of the dirty secret, interest elasticity is very low in the US. It's only through the exchange rate that policy affects demand. But in India, we have young who are borrowing to buy consumer durables, to build houses. So therefore, interest elasticity estimated properly, the gap is very large, greater than the advanced economy level. And so you have that monetary policy affects fiscal targets, growth more, while fiscal policy affects monetary targets, inflation, when it is due to supply side shocks. But, and this gives and again I have a paper which shows that in such a circumstance, it's better to delegate to a conservative finance minister and a pro-growth central bank governor. And we seem to have, luckily had this combination that works. So if inflation is coming down, monetary policy can keep real rates below growth rates while reducing the volatility that has prevented us from benefiting from the snowball effect. Then this improves fiscal consolidation as well as growth, keeps inflation down. So this has been, I argue, the experience after the pandemic. All this has happened, and we can see the result in this graph, which is showing that both headline and core that remained within the band despite the large dotted line is actually the WPI, which showed very large fluctuations. And typically you had the WPI would affect the core, but it's not happened. You're seeing the range of variation of the core and the headline falling. Consumer prices are falling. So that would suggest that consumers are internalizing, firms especially. Again, there's some evidence that firms are internalizing that inflation target and they are not raising prices. In MPC, a lot of people were waiting for inflation to rise after the pandemic, core inflation, but it has consistently fallen. And we see that real interest rates, again, the range of variation is much lower the current period than it was in the past. So all the issues that I've discussed, we've seen this actually happening in this period. One very interesting chart, this shows the movement in fiscal deficit and revenue deficit. And after the GFC, we saw the sharp rise in deficits. But I don't know how to get this cursor. But if you see the period after 2008-9, there's a jump up. And then it's like a plateau, it doesn't come down for a long time. So this was a period in the 2010s when growth was low, so the ratios remained high. And also fiscal consolidation did not start for 4-5 years. The sharp peak, we are seeing the peak during the pandemic, but immediately after that there's a fall, partly because of the good growth recovery, negative growth followed by positive, partly because deficits are being brought down. And the composition, we are seeing a fall in, problem was through the 80s, the revenue deficit kept rising. That means the quality of government expenditure was really undesirable. So these lines show the show the real growth rate and that snowball effect, the gap between the real growth rate and the real interest rates, calculated in two different ways. And we see that inflation led to a large gap, but this was very volatile and needed monetary policy to tighten. While in the recent period, the gap is rising again, but it is more stable, well, it is, and therefore more sustainable. To briefly contrast with a policy in advanced economies, we know that in the US, for example, the fiscal deficit rose by some 30% of GDP. And checks were just handed out to everybody. My favorite story is of a friend of, the son of a friend of ours who was running an NGO in the Netherlands, got a lot of payment from the government, and the NGO wasn't working, things were shut down, so he used that money to travel the world. In India, we had the opposite. We said not enough was done to help small firms, but we did not create zombies then. And I think that when you get, when we talk about helping the poor, then we must always remember that we have more than 1 billion population. And therefore, what is involved in any kinds of transfers or subsidies can be really huge amounts. If the US needed 30% of GDP to have an equivalent impact, we would probably need 100% of GDP, which is absolutely not feasible. So a lot of analysts were pushing for that kind of thing during this period, and immediately after that they started talking about how the fiscal deficit has risen and so on. But I think overall we followed a correct sequencing with no large demand stimulus while there were supply side constraints. And I think in the advanced economy we are going through what we went through after the global financial crisis, which is over-stimulus and then overreaction. So there was over-stimulus in the fiscal side in the US and then overreaction from the monetary, but the fiscal continues to expand. But that monetary over-tightening puts a lot of pressure on emerging markets because that affects global flows and inflows. And just as quantitative easing created huge inflows that reversed at the earlier sign of global stress, under quantitative tightening, can have the reverse, and that hurts emerging markets. I'm seeing that in the literature, even in advanced economies, there's a lot of attention on the supply side now after the pandemic. Yellen has talked of a new supply side economics. Danny Roderick has talked about productivism. But we demonstrated this at work during the pandemic. And it is very, very unusual to have policy that actually succeeds in under such difficult situations. And people at the RBI tell me that they get criticized for everything. They're out there, they're handling the whole economy. Whenever things go wrong, a lot of people are criticizing. And when things go right, nobody notices. But this last year, 22, was very unusual in that there were a lot of analysts, a lot of people saying that India has done very well. Because it was such a situation of poly shocks. And not only the pandemic, but spillovers from the Fed tightening, from the Ukraine war, and overreaction, because what they talk about, again, I can spend a lot of time talking about this higher for longer, and the IMF has also been pushing for that, but that you need rates to be kept higher for longer in order to prevent inflation expectations being de-anchored. The idea that inflation targeting is achieved only with a cost. And the same thing happens even if in an economy where it has been established for a long time. Then I think we should not use that argument in India. Because when there is a shock and there is some destabilization, then if the destabilization can happen in the US, it can happen here also. So we don't need to worry about establishing it at a high cost. And moreover, the 70s was very different because there were repeated shocks and inflation had been sustained at a high level for very long. But we are seeing that inflation has come down in the US also because this time the shocks were not sustained that long. And real rates were positive in terms of expected inflation. And I think the Fed has realized now that it's much better to be more data-based when there's so many uncertainties instead of announcing this blanket higher for longer. They also have a lot of financial fragilities. A lot of the corporate debt has to be refinanced. But while in India, we've gone through, because we went through the 2010s, where corporate and bank balance sheets were stressed, they were restructuring. So our debt levels are very low now. For the corporates, they're cash rich. We don't have the same stress. So this independence from the US Fed, which is a precondition for counter-cyclical policy for India. What is again in class I very often use this. This is the uncovered interest parity, which tells us the relationship between interest rates in, say, India and the US. So Indian interest rates must equal where there are free capital flows. This arbitrage will ensure that interest rates are equal, plus they must cover for expected depreciation and country risk premium. But again, some papers I've done with students, we showed that for emerging markets, is a panel for emerging markets, risk premium and exchange rate change matters more than the US interest rate for Indian interest rates. That US monetary policy matters less than financial volatility, especially for debt flows. And we will see, I'll just show some charts that after in this post-pandemic period, the interest differential has fallen to the lowest it has ever been in many years. And yet we saw after 2022 end, when the interest differential decreased, that very large inflows came in. And one reason is how carefully sequence capital account convertibility, cap on debt flows. The capital affected by UIP is small as the size of the domestic market. Moreover, since our macros are more stable, the country risk premium has fallen. Size, economic diversity, etc. is all helping. So, moreover, the other sort of new reaction after COVID-19, because again, international advice to emerging markets is the most conservative, follow the strictest policies after any shock, because your shocks are more persistent and last for longer. But this time, the RBI really expanded its balance sheet after the pandemic. But unlike after the GFC, this time the support was timely, time-barred, and reversed with continuing reforms and strengthening corporate governance. This also reduced risk premiums in the financial sector. In fact, there's very interesting research currently internationally on resilience after all these shocks. And it suggests that central banks should target risk premiums wherever they are in the financial sector to improve resilience. And in effect, this is what we were doing, what we did with a reduction in exchange rate volatility that reduced the forward risk premium in the foreign exchange market. So this is showing the spreads and how they fell over this period for 10-year G-Secs and the repo rate. We see that the spread really fell throughout this period, but in the last period, when the spread was the narrowest, largest inflows in a long time. So again, that inflows are not dependent on interest differential in India. The financial sector deepening, I've already talked about this. So this is one of the reasons that growth was expected to tank in India. But again, the broad regulation, the kind of help given without creating moral hazard. So it was interesting because I just joined the MFC and they were bringing out the financial stability report. And there, as a bank regulator, they forecasted that NPAs would rise. And I remember saying in that meeting that no, they're going to come down, because I was just coming from a bank board. I had resigned. I'd seen the kind of PSU, the largest NPAs, and I'd seen the kind of things they were doing. So, the story gets stuck in people's heads. People were convinced Indian banks are fragile. But they had actually restructured and they were very strong. They were in a good position. We've seen PSBs are really making profits in this period, doing very well. And all this reduced risk premiums in the financial sector. Then reducing volatility of the exchange rate again directly enters that interest differential. Lower expected depreciation. Again, a lot of research shows that the UI, there is excess premium charged in emerging markets, and average figure is about 3% excess premium that exceeds actual depreciation. So markets make excess returns from emerging markets, and using multiple instruments can reduce volatility, risk and spreads. And the large foreign exchange reserves, strategic intervention, signaling, macroprudential measures are some of the different instruments that were used. And over this forward exchange rate premium really fell. It was 5.19 over 2014-19, 1.95 in 2023. And again, the interesting experience being in the NPC is getting feedback from the markets. They were really nervous as reserves fell. But the idea of building buffers is you must use them. And so I think the markets gained confidence as some reserves were used and then recovered without major problems. And all this intervention, multiple instruments helped keep the real exchange rate near equilibrium, because we have a large trade deficit, so we can't afford too much appreciation. This happened in the 2010s, when Indian exports really fell while global exports were booming. But keeping the real requires intervention. So recently the IMF, and I like to say that maybe international rating agencies as well as the IMF have a lag in understanding the sources of shocks and the space in EMs that are following better policy, because their advice is focused on minimizing risk, and they really object to the kind of policies we have been following. For example, they label the Indian regime as a stabilized arrangement, not floating. In the period December 22 to October 23, And this was a period when large surges were coming in when the rupee was already at its competitive level, the real competitive level, and would have appreciated above it. And so the main point is that you cannot judge a regime from a short period. I've studied this, a number of papers on it. There were periods in the past where volatility really came down, but they were short periods, and then volatility recovered. Some volatility is good for market price discovery and hedging. In India, the regulator does not seek to fix the exchange, the nominal exchange rate. It is market determined. But if there is overshooting or undershooting that is leading to deviation from competitive equilibrium values, then intervention is required. So you can see that there was appreciation. This is the real exchange rate on two different indices, base years. You can see that there was real depreciation through the 2010s, and this had been reversed after the pandemic. Then another major kind of learning and in the MPC and how inflation targeting works is the importance of communication. So, and this is how the literature changed, because earlier the view was that a central banker should say as little as possible and say it in a manner that nobody can understand it. So Greenspan used to mumble under his breath and so on, because the idea was only unanticipated money, only surprise matters and can affect real variables. But the multiple equilibrium view, which currently dominates, and Bernanke and Yellen, they were all exponents of this, is that it's actually about guiding market expectations towards better outcomes, that there are multiple equilibria possible. And this is the dominant paradigm for central bankers now, and this is the paradigm from which inflation targeting has evolved and why it is forward-looking. Because markets are not perfect and there is learning, they can get stuck in poor outcomes, and therefore, and there is a lot of research again which shows how communication can move interest rates with much less in terms of actual quantitative interventions such as OMOs and so on, raises the signal to noise ratio and overall lead to better monetary policy outcomes. So what was the communication? I think that overall there is clear guidance on emphasis on the target. In the initial years after the pandemic, obviously growth was a focus, and so the markets decided that this MPC is not concerned with the target. But as soon as growth recovered, we started emphasizing that target, but also that in a period of a lot of uncertainty, data dependence, explaining the central bank's reaction function, so that markets can look at incoming data and decide what the central bank will do and therefore take positions accordingly. So you're not telling them higher for longer. And that is a mistake the Fed again made last year when they got worried after they stopped raising. The markets are now kind of cutting rates too much. The G-Sec rate fell, so they gave very high forecasts, the dot plots and so on, and markets again overreacted. Then they had to adjust again. So instead, just say data dependence, and that your own forecast is dependent on incoming data. But this data dependence has to be informed by theory and structure, which affects forecasts. So that structure I talked about, aggregate demand supply, some such structure, some estimation, some idea of the structural features of the economy helps you to forecast better what is going to happen. And again, I have a number of papers where I looked at with the student at the inflation expectations, and we find that communication, again the IMF and their view is that in emerging markets subject to so much shocks, you have to have imposed really high growth sacrifice, keep real rates high for really long in order for inflation targeting to get accepted. But we find that in thin markets, and more hierarchical systems where people pay more attention to what the RBI governor says and so on, that communication can have more of an impact. And this seems to be the case in India. We find in the recent period that causality runs from, not from the headline to core, but from core, which is more persistent, to headline. And as I said, credibility has a major role in anchoring inflation expectations. And what is required for credibility is not very high real rates, out of equilibrium real rates, or communication that's going to be higher for longer, but only that if inflation exceeds our tolerance bands, we are going to raise rates. The real rate is going to be near equilibrium. That is enough for credibility. And as well as a continuous communication about the target. But again, communication has to keep in mind market sensitivities and overreactions. So, I don't know how much time I have because we started late, but it's 5, so I think I'll finish there. So I don't want to end by saying that everything is perfect and things are going marvelously. There are a lot of risks out there, a lot of things can go wrong, but we all know about climate change, our sensitivity to crude oil prices, but in some way there are also opportunities in all this. India has always suffered, given its large population, importance of food prices, the lags in agricultural productivity, but again there seems to be some improvement there also now. And we need to build resilience against climate shocks. Then buffers against external shocks and using them. We've been doing that. And we've shown that there is space for counter-cyclical smoothing. Here, policy choices really matter. Countries like Indonesia, that foreign bonds are 40% of their domestic market. During taper tantrum, we were 4%, and they had much more interest rate volatility. So this UIP, it holds for Japan, it holds for UK, it doesn't hold for us today, but that doesn't mean it won't hold in the future. But as long as we do not let foreign they contribute to domestic market and they should not become too large, then we are okay, we have that freedom. Oil price fluctuations, again, this is, maybe it's become less important as we move towards green and already our energy intensity has come down. Overall, just to summarize the lessons for macroeconomic policy, I think the major lesson this period is that flexible inflation targeting really works. Because in the first period, the advantage was oil prices fell and you reached below 4%. But in this period, we had really large oil shocks and other shocks, and yet it has worked despite these really adverse supply shocks. But flexibility is essential, especially given India's development stage and complexities. And the more these supply shocks become transient, the more flexibility. And there are signs over the last 6 months, we've seen that supply shocks have not lasted for long. There is more flexibility then to look through them. They don't have persistent effects. And overall fiscal supply side action is really important. We've discussed this. While the monetary role is to keep the equilibrium real rate, don't let it go too high or too below that, to change the repo rate to anchor inflation expectations, use multiple instruments to smooth shocks. So I'd just like to summarize by this, which stands for balance, counter-cyclical, coordination, credible, communication, and reforms. So we discussed about the balance between demand and supply, between the real rate, keeping it at equilibrium means you are increasing savings but stimulating private investment. Sequenced opening, balance between openness and domestic needs. Governance, but free markets but regulation for financial stability. And counter-cyclical, I think that I put it in capital because we're all looking for an improvement in private investment. And I think through the 2010s, whenever private investment was recovering, there was global volatility, rates were raised, financial conditions were tightened. This time, if we can keep smoothing, then there is a chance that private investment will really recover. Credible has a capital E because credibility helps anchor inflation expectations. And communication is an additional shock. And one major, counter-cyclicality is very important. So responding to both external external risks and domestic, I think the more people are aware, for example, this recent farmers' agitation or elections and freebies, I think the money could be spent so much more effectively in providing public services to that individual and helping them participate in growth. So I think overall it's important to extract and internalize these lessons so that in the future we learn and we adopt, continue to use what worked. But of course for this lot of debate and research is required. Thank you.
Thank you, madam, for your wonderful reversals.
I'm going to open because Ashima has given such a nice talk, and I'm sure many of you have thought. I would request that we keep it only to questions because I will not open the floor for another keynote address. And keep it very brief so that we can give space for Ashima to answer. So you had a question, yes. Do you have a mic? Is there a mic there?
You can be louder.
No.
Yeah, no. Please.
Thank you, madam. It's a very excellent lecture and many thanks to you. You have covered almost all the aspects of macro parameters. Stability, stable growth, external balance, everything, and the flexible inflation targeting that works in our country, that's fine. But in macro policy and monetary policy, you didn't mention any issue of unemployment, this growing unemployment. Without employment generation, and this growing inequality, how the macro policy and specifically monetary policy can address these two problems, growing inequality and growing unemployment. Thank you, madam.
Thanks. Okay, maybe we'll take one or two more if there's anybody else. Yes,
Thank you, Ashima, the wonderful talk. A specific question on monetary fiscal coordination, you referred to that in one of the slides. My specific question is that in the last perhaps 5 or 6 years, the de facto ownership of government debt is just going into the RBI. And so it's as if it's not called monetization, but it's de facto monetization because 80% of the bonds end up, at least there was a period, I don't know what the current situation is. And the other aspect is that the RBI dividend payment to the government cumulatively over the last perhaps 6 or 7 years has been just very, remarkably high. So I don't know whether this is what you meant by monetary fiscal coordination, that essentially, I'm just being a little sneaky here, but would you like to comment on that?
I'll take one more maybe.
Good evening, ma'am. I want to ask what is the role of monetary policy at firm level?
Yeah, thank you for the questions and the interest. Now, unemployment and inequality, that is exactly the structure, those aggregate supply curves that I had shown. Typically, you say that the aggregate supply is vertical. Why do I say it's horizontal or elastic? Because you have unemployment, you need to create a lot of jobs, and as long as you can tackle the supply side bottlenecks that are raising costs, then you can sustain demand so that output increases, investment rises, more capacity is created. And if the real rate is low, there's fiscal conservatism, the cost of borrowing falls, then that average young entrepreneur can borrow and, start a business and earn and employ others as well. Yeah, so this is actually policy to increase employment and reduce inequality in a sustainable way. Now for Ajit, very interesting questions. People just see red flags when you talk about coordination. That means you're accommodating, helping, and so on. The coordination I was talking about was just that fiscal action to reduce costs to bring down that aggregate supply. So when monetary policy can sustain demand, which raises output. Yeah? So it gives you higher growth and lower interest rates. But the questions you have raised are also important. But actually I've studied this very carefully. I've looked at it over time. RBI holds very little of government debt. It's the US Fed that holds huge amounts. Or because we have so much of inflows, the central bank balance sheet can be either domestic or foreign securities. We hold so much of foreign securities, 600 plus billion, that the RBI cannot hold too much of government debt given the money supply targets that it has. And its payments to the government are partly because as the US yield, last year for example, US yields went up so steeply. I don't know. I mean, the intervention, they earn more on what they hold in US treasuries, so they can pay more. And it is all formula driven. There's a Rakesh Mohan committee and so on. So what they pay is based on a formula, there's no discretion. Then the third question was how monetary policy affects a firm. So when I talked about anchoring inflation expectations, for those of you who do research, and there's so many students here, this is a very interesting question to take up. How do firms set prices? The Phillips curve we talk about in macro has a core inflation, or expected inflation. And then you look at your output gap and so on. And again, with the student, we did some work, I think someone should repeat it with more recent data, that looking at the skew in the distribution of price increases at the firm level. But one of the puzzles we are seeing in the MPC really is that core inflation keeps falling. Everybody thought that, pandemic costs had risen. Now, this is an opportunity as growth recovers for firms to raise prices. But I've had some research where the markup is counter-cyclical and so on. So I was arguing, and there are these supply-side changes which are reducing costs. So I expected it to come down. And so far we are seeing core inflation coming down. Yeah? So, and one reason it would come down is if they are internalizing that inflation target. So they don't want to raise, and the other issues such as regional competition, lower demands, etc., etc. Yeah?
Well, I think we close the session now because we are a little over time, not a great deal, given that we started late. I do want to thank Ashima for a really lovely talk, and she spelled out so many of the issues. I am going to suggest all of you to reflect on this talk, and maybe if Ashima is circulating a written version or something later, people can take a look. She's raised many questions, and one of them I'll emphasize and close with that. She talked about the extreme importance of a data-dependent monetary policy. I think I would like all of you, and given where I come from as a chief statistician, to think about this and interrogate the data which lies behind monetary policy and try to sort of see what sense can you make of that data, and maybe you will be able to offer suggestions or ways to think about monetary policy if you take a closer look at the data. Don't get hung up in standard theory, but look at the data. That's what I would argue all of you need to do. And I'll hand the session now over to the organizers for their part.
Thank you, sir. So, this is a wonderful session which is delivered by Prof Ashima Goyal, and the chair is Dr. TCA Anant, former Chief Statistician of India. Now, on behalf of the Organized committee, a token of love that we are giving to these distinguished persons. So I am calling first Sukanti Rai. So please felicitate Professor Ashima Goyal on behalf of the Organized committee. Now I am calling Debnath to felicitate Dr. TCA Anant, former Chief Statistician of India.